From Trump-driven tariff jitters to currency swings and geopolitical shocks, the Indian capital market has powered on to fresh highs towards the end of FY25, proving that when global chaos strikes, India's resilience writes its own script. Investor participation has been a contributor, with the number of investors more than doubling from 4.9 crores in FY20 to 13.2 crores as of 31st December 2024. Looking at India's primary capital market, this growth is combined with active listing activity, as India's IPO market had its best ever year in 2024 with $20.5 billion raised, second only to the United States. And turning to the performance of the secondary markets, since the commencement of FY25, they have experienced significant volatility driven by various events. In line over the past year, the Nifty 50 has grown by just 4.8%. But stretch the lens to 5 years, and that picture changes dramatically. 140% surge that outpaces most of the world's major benchmarks, from the Nasdaq and the Shanghai Composite to the FTSE 100 and the Nikkei 225. In fact, for example, the total market capitalization of BSE listed stocks has crossed above $5 trillion, a feat only achieved by 4 other countries. Another key metric to analyze is the Buffett indicator, which is the ratio of total stock market capitalization to GDP. It gives an economy-wide snapshot of market valuation. According to this indicator, a market capitalization to GDP of below 75% indicates a historically bargain zone. 75 to 100% indicates that the markets are fairly valued, and above 100% indicates that the markets may be overvalued. Now, when it comes to the Indian economy, the Buffett indicator bottomed out at just 23.28% of GDP in FY03, a stark signal that stocks were deeply unloved. By FY08, exuberance had driven the ratio above 109%, clearly flashing a frothy market on the eve of the global financial crisis. After the COVID-19 crash, valuations reset to about 95% by the end of 2020, just under the 100% fair value threshold, offering a more reasonable entry point. Fast forward to December 2024, and the ratio has climbed to 136%, well above its long-run norm, and a warning to tread carefully and focus on quality amid richly priced markets. Since the pandemic, individuals and households have dramatically stepped up their participation in capital markets, both by trading equities directly and by investing through mutual funds, a trend known as financialization, where everyday savings are increasingly channeled into market-based financial assets. But what has driven this rapid surge in financialization? A critical modern driver is India's robust digital public infrastructure, often dubbed as the India Stack. This includes Aadhaar, UPI, e-KYC, and DigiLocker, and IMPS for easy payments. These have dramatically lowered transaction costs and onboarding frictions. For example, online brokers leverage Aadhaar e-sign to open millions of Demat accounts completely online in minutes. UPI's success means that even small savings and investments can be done digitally at scale. But above all, mobile trading has revolutionized the industry by putting the markets in the palm of your hand. Fueled by wider internet access, rising smartphone use, and falling broadband costs, a wave of fintech and discount brokers emerged in the mid-2010s. With zero brokerage models and rock-bottom fees, they slashed the transaction costs, opened the markets to everyday investors, and sparked a dramatic uptick in retail participation. The result? Incremental addition to Demat accounts has been continuously increasing, with the number of Demat accounts rising sharply by 27.2% to 192.4 million by FY25. Higher investor participation has engendered a self-reinforcing cycle of strong market returns, bringing even more investors. For example, the mutual fund industry has grown well. Over the past decade, India's mutual fund AUM has skyrocketed from 12.04 trillion rupees on May 31, 2015 to 72.2 trillion rupees as on May 31, 2025, nearly a six-fold jump. Moreover, SIP has democratized equity investing. Everyone is an investor. Retail participation via mutual funds is evidenced by the soaring SIP contributions, which hit an all-time high. Monthly SIP inflows nearly doubled from $1.7 billion in early 2023 to $3 billion by late 2024. Financialization has uplifted the entire ecosystem, not just individual investors. For years, India's markets were at the mercy of fickle foreign portfolio flows, whipping volatility and sentiment swings. But as our domestic investment industry has matured, it has become a powerful stabilizer. Between July and October 2024, FPIs recorded their largest net outflows of $13.9 billion since the global financial crisis. Yet, instead of a steep crash, the market slipped only 0.04%, a stark contrast to the past 38% plunge in 2008 with outflow of just $8.4 billion, thanks to the timely buying by domestic institutional investors. This wave of financialization has created clear winners across India's economy. Companies that enable or capitalize on the surge in market activity have seen robust growth. We can divide them into two groups: direct and indirect beneficiaries. Direct beneficiaries are our wealth and asset managers. As households increasingly channel their savings into financial assets, these firms have prospered by capturing rising inflows, growing their AUM, and expanding their market footprint. Now, let's review the performance of a few key direct beneficiaries. First, let's consider Anand Rathi Wealth Limited, a full-service manager for HNIs and mass affluent investors, offering equities, mutual funds, debt products, insurance, etc. Over the last 5 years, its revenues have climbed at a 24% CAGR, driving a 37% profit CAGR and delivering exceptional 41% return on equity. Next, Nuvama Wealth Management delivers an integrated offering, blending in-house and external relationship managers with capital market broking, underwriting, and an AMC arm to serve both domestic, HNI, and offshore clients. Over the past 5 years, it has led the pack with a 40% sales CAGR, a 29% profit CAGR, and a 21% CAGR in return on equity. Third, Motilal Oswal is a double-engine financial powerhouse combining wealth management and broking with asset management, private equity, real estate funds, and a proprietary treasury. Its broad suite has fueled a 29% sales CAGR and an industry-leading 69% profit CAGR over 5 years, alongside a 26% CAGR in return on equity. Lastly, Nippon Life India Asset Management, one of the country's largest AMCs, runs mutual funds, ETFs, passive strategies, alternative investments, and PMS for both retail and institutional clients. In a fiercely competitive market, it has delivered a 16% CAGR, a 25% profit CAGR, and a 26% return on equity. Clearly, these companies have outperformed the broad market. So what really moved the needle for all 4 firms? Let's dive in. First up, it's about scale. As Indian households and institutions reallocated servings into market-linked products, each firm rode on an unprecedented wave of assets under management, directly translating into richer fee pools. Anand Rathi saw an AUM surge from 18,355 crores in FY20 to 77,100 crores in FY25, driven by a record 12,600 crore rupees of net inflows last year alone. Nuvama has also delivered impressively across its segments with a 4-year CAGR of roughly 30% in wealth, 19% in private assets, 43% in asset management and 47% in asset services and capital markets, underscoring its broad and fast growth. Motilal Oswal's assets under advice in a decade have grown at 39% CAGR, now at 5.5 lakh crores, while its mutual fund AUM has grown at a 42% CAGR over the last 5 years to 97,586 crore rupees, solidifying a dependable stream of recurring fee income. Nippon Life AMC's mutual fund AUM has nearly tripled to 560,926 crore rupees over 5 years, growing at a robust 26.4% CAGR. Secondly, these companies blended old-school relationship models with cutting-edge digital platforms so that no investor, whether in Mumbai or Madhya Pradesh, was out of reach. Anand Rathi now has 6,444 certified advisors on its Omni Financial Advisor network, servicing 22 lakh clients, plus a growing digital wealth arm that onboards investors in minutes. Nuvama operates 1,300 plus in-house RMs and 7,000 plus external partners on one tech stack across 500 plus locations, tapping both India's tier 2 and 3 and expatriate markets. Motilal Oswal boasts of 2,500 plus RMs, 9,100 plus external associates, and coverage in 98% of PIN codes, backed by analyst-driven digital tools. Third, diversification of revenue streams. They didn't just rely on broking. Each expanded it into advisory fees, leading alternates and more, creating a fee bouquet that cushions against market swings. For example, Anand Rathi has smartly broadened its business well beyond the pure equity advisory, building a true fee bouquet of products. Today, core distribution of financial services accounts for just over half of revenues, while mutual fund distribution contributes another 43%, and even niche IT-enabled offerings and other services fill out the mix. On the other hand, Motilal Oswal has also built a truly multi-pronged franchise, spanning wealth management, asset management and advisory, capital market services and home finance, so that no single business cycle can derail its performance. Fourth, operational efficiency and cost management. Finally, behind the glamour of the growth lies disciplined execution, lean cost structures, and process improvement. Anand Rathi, for example, has trimmed its cost-to-income ratio to 59.1%, cut advisor churn to 0.5%, and boosted AUM per RM to 198 crore rupees. Nuvama has also sharply improved its operational efficiency over the past 4 years. Its wealth arm cut cost to income from 90% to 67%, while the private segment trimmed costs from 85% to 66%. Together, these three pillars, scale, distribution, diversification, spell out exactly why financialization has turbocharged India's wealth managers, as a result delivering impressive stock gains. Now let's come to indirect beneficiaries, starting with stock exchanges themselves. They benefit almost directly from financialization. More investors and trades equals higher transaction fee, clearing fee, data subscriptions, etc. The National Stock Exchange, though unlisted, is India's dominant exchange with 94% market share and considered to be India's most valuable unlisted company.
The exchange's financial performance for FY25 showed revenue growth of 17%, reaching rupees 19,177 crores, whilst net profits saw a substantial increase of 47%, totaling 12,187 crore rupees.
Sample this. In the last year, NSE achieved net earnings of $1.35 billion, surpassing both Nasdaq's $1.1 billion and the London Stock Exchange's $1.15 billion in reported profits. On the other hand, the Bombay Stock Exchange has seen a turnaround by leveraging new segments. In FY25, BSE Limited's total revenue doubled to 3,236 crore rupees, and net profit jumped 71% to 1,317 crore rupees. Q4 FY25 alone saw profits surge 362% YOY to 495 crore rupees. This was driven by a derivatives trading boom, rapid growth in mutual fund transactions on the BSE Star MF platform, the country's largest distributor gateway, and a surge in IPO listing fees amid a flood of new offerings. Since hitting its 2020 low, BSE's share price has skyrocketed to record highs in 2024, surging a staggering 4,623% over 5 years, and today trades at approximately 2,639 rupees. Moving on to commodity and other exchanges. The Multi-Commodity Exchange, India's top commodity derivatives exchange, experienced a resurgence in FY25. After a slowdown in commodities trading, MCX saw volumes rebound strongly. In FY25, revenue jumped 63% and PAT soared 574% to 560.04 crore rupees, almost a six-fold increase. This was driven by average daily turnover nearly doubling YOY, with options and premium turnover alone climbing around 85% on heightened activity in energy, bullion, and base metal contracts. Moreover, MCX has sustained its strong momentum, delivering a robust 25% CAGR in profits over 5 years. In line, its stock has also grown at a 47% CAGR over the past 5 years. Next up, we have depositories such as CDSL and NSDL. The depositories have seen an explosion in new Demat accounts. Central Depository Services Limited saw its revenues and profits soar in the last few years, as profits grew at a 38% CAGR over the last 5 years, and even in FY25, it had robust 25% profit growth, given its charges for every new account often opened via discounted brokers and for increased transaction volumes. Its stock has also delivered impressive returns, rising at a 64% CAGR over the past 5 years. Discount brokers have been the biggest enablers of new investor participation by cutting costs and simplifying access to both stocks and mutual funds. For instance, some discount brokers saw revenues top $1 billion in FY24 with profits of 4,700 crore rupees, while others tripled their profits to 1,819 crore rupees by FY25, proof that low-fee, tech-driven platforms are drawing millions of first-time investors into the market. Credit rating agencies like CRISIL have also benefited from India's financialization. In the past 5 years, CRISIL has delivered a 13% sales CAGR and a 14% profit CAGR, powered by booming bond issuances, NBFC lending, and capital raising activity. As our markets deepen, every new rupee of debt or equity issued increases the demand for ratings, surveillance, and analytics. Reflecting this momentum, its stock price CAGR has grown at a 28% CAGR over the past 5 years. Looking ahead 5 to 10 years, India's financialization is poised to deepen further, although it shifts in the landscape. As India is projected to be the world's third largest economy by 2030, its capital markets are on track to become among the most financialized in the world, not only in market capitalization, but in the breadth of retail participation and depth of digital integration. Direct equity and equity mutual funds jumped from 5.3% in FY14 to 15% in December 2024, while fixed low-return products slid from 68.8% to 59%. This reallocation towards higher return equities reflects financialization and is likely to keep rising as households chase better yields. In line, asset management and wealth businesses are set to see continued expansion as India's mutual fund industry is on track to hit roughly 100 trillion rupees in AUM by 2030, implying a compounded annual growth rate of about 14%. This rapid growth reflects India's still low penetration of professionally managed financial assets, Despite being one of the fastest growing markets globally, India's share of household savings invested in mutual funds remains only 1/4 that of the global average. Now, looking ahead, financialization could accelerate more aggressively, powered by key drivers. First, wealth tech will make investing more accessible. By 2030, India's wealth tech market is projected at $237 billion, driven by robo-advisors, AI-based portfolio algorithms, and digital platforms that can serve even small investors. Secondly, Digital Finance 2.0 will cement India's role as a fintech powerhouse. By 2030, AI and blockchain could converge in lending, automating underwriting, verification, and disbursal on secure, decentralized ledgers. Lastly, capital market infrastructure will broaden the new products. Commodity options, carbon credit trading, and emerging options like direct international investing will go mainstream. Exchanges could further internalize, such as NSE's offshore Gift City exchange, and depositories and clearinghouses will see rising volumes and embrace blockchain settlements, reshaping their revenue models. Yet, this rosy outlook hinges on a stable macro economy, ongoing reforms, and a rigorous risk management, because rapid financialization carries challenges that policymakers and investors must tackle. First, asset bubbles and overvaluation. India's market cap to GDP ratio is high at 136% versus its peers, and soaring asset prices risk bubbles. If valuations outpace fundamentals, a sharp downturn could wipe out wealth and unsettle market confidence. The 2024-25 economic survey also warns that excessive equity claims may herald instability. We're already seeing froth in the bumper IPO subscriptions, IPOs of SMEs without any track record, and sound financials are getting oversubscribed many times, driven by retail investors chasing listing gains. Such over-financialization, wherein too much credit chasing too few productive uses, can inflate asset values without real growth. Even the stocks we've covered as beneficiaries of financialization, despite impressive stock price gains, now trade at lofty multiples, signaling that the rally has outpaced fundamentals and could expose the market to correction if expectations prove too generous. Another cause of concern is that historical data shows that India's equity market has grown increasingly sensitive to US moves. Today, the S&P 500 sits near its third highest ever PE ratio, a clear warning sign of overvaluation. And the recent rally has been driven almost entirely by a handful of tech giants like Apple, Microsoft, masking broader market weakness. With doubts rising about whether corporate earnings can keep pace, a correction in the US could quickly spill over into our markets. Bottom line, as India's middle class slides into the affluent bracket, we are seeing a wave of fresh capital flowing into equities and mutual funds. That tailwind is exactly what makes the capital markets theme so exciting. More money, more trades, more long-term SIPs. Wealth management, meanwhile, is still in its infancy here. Only a fraction of high net worth and mass affluent households use dedicated advisors, leaving an enormous runway for growth in advisory fees and portfolio solutions. Here's the issue. It isn't just free money forever. Valuations across discount brokers, AMCs, and wealth tech plays have already raced ahead. In other words, while rising affluence underpins the theme, stretched valuations could mean any hiccup in GDP growth, while market sentiment could trip up even the best positioned firm. High growth potential? Absolutely, but at the risk of high valuations. With only 3% of Indians invested in equities versus 55% in the US and 13% in China, the runway for further financialization is enormous. Yet, with lofty valuations and mounting risks, how do you see this unfolding? And which sectors or companies will emerge as the biggest winners over the next decade? Do share your views in the comment section below.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.